Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Chris Irons, also known as Quoth the Raven on Substack.
Chris is a very smart guy, and he's a salty old dog, so get ready for that. But get out your pens and pencils. He's got a lot of great ideas about what is happening in the world right now that I want you to hear. You need to hear them, in my opinion, and you need to hear them in a different way. And this is that way, so let's do it. Let's talk with Chris Irons. Let's do it right now. All right, Chris Irons, welcome to the show, apparently for the first time ever. I thought you'd been on before, but I guess not.
Happy to be here. And as I said before, I thought my half-life with ever being invited back to anything Stansberry after my 2019 on-stage performance in Las Vegas was much longer than 6 years. I thought it was going to be at least 20 years, but it's great to be back 6 years later. I'm not surprised it took so long.
Well, so you know how people are. They hear a little salty language and they get all flustered.
Yeah, well, I appreciated the invite, and happy to be here.
Yes,
Yeah.
And
You're putting too much stock in our planning as well. That if you think that
that's right,
that was an issue for us. Yeah.
Hey, I enjoyed myself. I get invited to these like conferences and things, which I don't really do too many anymore. I do still get invites, and my thought process is like, if I go, I go. If I don't, I don't. I'm not, I'm just going to go and say what I want to say, and that's going to be it. And if I don't get invited back, that's okay. I remember the guy at your stage show, because everybody, it was like very professionally done, professional sound, professional everything, great crowd. It was like, oh yeah, do you want to wear a jacket? I remember he asked me like, do you want to wear a suit coat? Because I had a tank top on because like about 30 minutes before the presentation started, I was out at the pool. It was at the Wynn, right? I think I was.
So.
Yeah, I was out at the pool drinking beers and having a good time. And I looked down. I was like, oh shit, I got to be on stage in 30 minutes. So I ran inside, and the guy's like, do you want my suit coat? I was like, no, it's 90 degrees outside. Anyways, I have graduated from a tank top now to a sleeveless shirt. And so maybe in 6 years, when you invite me on again, I'll be wearing a button-down shirt.
He's getting closer to sleeves, folks.
Yeah.
It's a process. It's an evolution.
Longer.
Yeah. Well, I enjoy your commentary. I enjoy your presentations. So, apparently I have some amount of sway over who gets on this show. So here you are, and I'm happy to have you. I'm happy to have most folks who are self-professed, libertarian and Austrian economics oriented, as are you. So yeah, happy to have you here. And of course, you're an investor too. So there's potentially lots of stuff to talk about. We might start there. In fact, I'd like to start there if you don't mind.
Sure.
What does an Austrian-minded fellow like yourself think of, things like tariffs? Is there any good outcome potential from this? From the highest tariff since the 1930s. Okay.
Yeah, I think a lot of the criticism of tariffs, and the fact that it does eventually work its way back into prices does make sense. There's some people who argue against that, like Jim Rickards did a pretty good job of, making a case as to why tariffs don't affect prices. But one way or the other, between tariffs and between monetary policy, nominal prices are going to continue to go up regardless of what we do. And that's part of like my broader kind of macroeconomic thesis, which is the Fed will do anything at all costs to try to save face at any point. And so, I think not to carry the Austrian school / libertarian / like Peter Schiff disciple line, but I do think at some point we're going to have an extremely sharp deleveraging. I think it's going to be worse than anything that we've seen thus far. Not saying that to try to elicit any type of response, just out of common sense with the way that this cycle goes, which is, we crash, we print more, we crash, we print even more, we crash, we print even more than that. And so the MMT kind of like abusing the corpse of the dollar cycle that we're on right now, it just accelerates and gets faster and faster as time progresses. And so naturally with that come bigger and bigger distortions and bigger drops in the market. As far as the idea of tariffs as a political strategy, like, I don't hate it, because I think that there is look, the only thing this country exports right now is dollars. I mean,
Right.
we don't manufacture anything here. And so the case that I made was, look, back during COVID, when we needed important items, when the supply chains were really gummed up, we really found out during COVID just exactly how many items come from overseas. And it was, maybe a year or so that we were walking into stores, and it was natural for half of the shelves to be empty because the items from overseas weren't getting here anymore, or they were trickling in. And so what you'd see is this small selection of items that were manufactured in the United States or had finally made their way over. But more importantly, are the things that Trump is talking about, like the ingredients that are used to make pharmaceuticals, the pharmaceuticals themselves, the rare earth minerals, the things that really, in the balance, hang significant portions of our quality of life. And so I don't think that it's a bad idea, as misguided as I think some of the tariff rates were that Trump came up with and the calculation that he used was. I don't think it's a bad idea to make this hard stop and say, listen, we have to do something, because when you drive through the Pennsylvania countryside in Northeast PA, and really even in places near like where I grew up in New Jersey, I think of one factory, for example, that used to be a Kimberly Clark factory, that just shut down. I mean, they were making tissues and toilet paper and things like that. And you see it in Detroit. You see it in places like Bethlehem. If you go to Bethlehem, Pennsylvania, you see like the whole steel industry is essentially shut down. And those are just microcosms of what's happened across the entire United States. So we used to be a country that manufactured its own goods, that had sound money, that was had a budget surplus, was in a much better financial position if you gauge financial positions through an econ 101 / common sense / like Austrian school point of view. And so I don't think that the idea of wanting to rejigger our trade deficit is necessarily a terrible idea. I think that there are a lot of moving parts, not the least of which are, the cost of items that we get from overseas versus the cost of manufacturing here. But net, I think that it's a good idea, because it brings up, it puts into the zeitgeist the idea that the country doesn't manufacture anymore, which has been a problem for a long time. So if you're like me and you believe that we're overspending and we are over consuming, and that we have essentially entered a period of like, decadence, or like, just like, we have the global reserve currency, we use it, we weaponize it. And now, like, I find myself going to Europe, and I find myself going to like cities in Europe and thinking like, man, why doesn't the United States look this nice? And so in some ways it almost feels like we're over the, like, we've reached the zenith of like our, flourishing as an empire. And in order to try to correct any of that, first off, it's going to be near impossible to correct. It's like turning around the fucking Titanic, like, just doesn't happen quickly. But in order to do it, there are certain giant fundamental changes we'd have to make, not the least of which is, onshoring some manufacturing again. And then, of course, trying to cut spending and trying to balance the budget, which we're not doing a fantastic job of either. So I see the good and the bad.
Yeah. Creating real wealth is speaks for itself, right? And if you do less of that, and in the process are sending your net worth overseas, and what net worth you have, you're shipping it overseas, and then you're also not creating as much of it, could be a
I think
problem.
I think what's even more frightening from the Liberation Day debacle, what happened, I think if you want to take away from that,
Mm-hmm.
outside of arguing over tariffs, it would be the market's reaction to what happened and how quickly and swiftly it reacted, and then how coincidentally, after several days of down 2%, down 3%, and the 10-year and 30-year yields moving higher, how coincidentally, all of a sudden, like, there was a 60-day pause or a 90-day pause. And
Yeah.
I mean, people on CNBC were acting like it was the goddamn end of the world. Like, I thought
Right.
Steve Leisman was gonna fucking cry. It was just, and that speaks to a broader theme, which is sometimes when you want to make big changes, you have to deal with some discomfort. But nothing had even happened at that point. Like, the
Right. It was
pricing
all
shocks hadn't
announcements. Yeah.
hadn't hit, and nothing was missing from shelves. It
Right.
was just pure panic.
Yeah.
And the idea that, like, okay, the
That's right.
market went down 10 or 15%, and so now we need to just scrap this entire plan, shows you how truly trapped we are. Because if we get to a major sharp deleveraging event, and it will happen at some point in the future, where the Fed's not going to be able to stop it and the president's not going to be able to stop it, and then it's like, bar the door, because we have no idea what's coming next. But that will happen. But it just shows you just how beholden we are to the little number on the screen that has the S&P in it. Because, as I've written about, there's a million reasons we can talk about them, but, like, something like the passive bid, when that starts to dry up and people start to redeem instead of contribute, like, you're going to see a nightmare. And
Chris, I didn't get to it. I just saw the piece of yours about, it was, I forget the title, something about how passive unwinds, and I didn't get to it. So let's talk about that.
Yeah, that was one of the
The
things I was going to ask you about too, because we recently had one of our colleagues, Brian Beach, on here,
Mhm.
who's been talking about, and Dan too, talking about the passive bid.
We've had Mike
in
Green on.
and
Yeah.
Mike Green.
yeah,
Yeah,
well,
so
that Mike Green was the impetus for that piece. And really, basically, the piece that I wrote is, a lot of it is summarizing his thoughts,
Mhm.
because he's the person that I,
Right.
really sharpened my vision on this from. In fact, in that piece, it passes along a great interview that Michael Green did with Palisades Gold Radio, which the first half of that interview I thought was the best explanation for exactly how out of whack things could get due to the passive bid that I've heard thus far. What I knew going into that interview was that this passive bid, which is essentially routine forced buying through individuals who purchase ETFs that are weighted to the S&P, or people who contribute, regularly via their retirement funds, their 401ks, to these types of ETFs.
With
What
no
happens
reference to
is,
fundamentals whatsoever.
right, what
Yeah.
happens is those funds buy a list of names, usually the top weighted names in the S&P 500, proportional to the amount that you invest in the ETF.
Mhm.
And what they don't do is they don't look for value. They don't look at price to earnings ratio. They don't look at price to sales ratio. They don't look at where the market is. It is a consistent purchasing program that doesn't let up regardless of valuation. And in the case of, nowadays, you see market breadth, meaning the amount of companies that are driving the index higher is getting smaller and smaller. So it's not uncommon to see a case where you have 60% of the S&P red on a day, or 65% of the entire index red, but the index itself green, because the higher weighted names in the index, your Amazon, Tesla, Microsoft, whatever, the Mag 7 and others, are green on the day. So they have been the equities that are driving the market rally higher.
Right.
And their valuations have gotten pretty stretched. I mean, you're talking 40, 45 times the earnings on some of these names. A name like Tesla, I mean, you're in the hundreds
100.
PE
Yeah.
right now. Right. And so the point that Mike Green was trying to make that was something that I did not know, because I knew how the buying worked. But what I didn't know was that when people go to redeem from these major, $20 trillion ETFs and funds,
Right.
meaning when you take those emergency draws out of your 401k, which happens when there's periods of financial distress or when you lose your job, when you do that, a lot of these funds don't have cash liquid to
Right.
absorb those redemptions. And what Michael Green was saying in this interview is that the funds have instead done things like taking on leverage, specifically so they don't have to sell.
Right.
And that's a great solution until you get to a point. It's only a great solution if the market continues to move higher. But basically, it could eventually become a margin call on these, multi-trillion-dollar passive funds, which when you add
Yeah.
that to a major margin call in something like crypto, which is levered 100 to 1, and individual personal accounts that retail investors trade in, you could have an absolute nightmare that it doesn't matter what the Fed does, because you
Right.
can't come in with a $20 trillion bid. If you're the Fed, I mean, you can, and they would figure out some fucking stupid way to do it and some dumb name for it. But then you're talking about 10-15% inflation or something the next year. And so there's going to be a blow off valve. And just to listen to Michael Green's perspective on this, and I recommend everybody listen to that interview.
Yeah.
As I tell my subscribers on my Substack, I don't know why you subscribe to me, because all I'm doing is just passing along what I learned from other people. But, it really seems like something devastating could be waiting in the wings there, if we do move low enough, fast enough. And that's the key. Will the market move low enough, fast enough that it will trigger these calls before we have a time to react, like we did with the Liberation Day? Like, when Trump and Bissent come in and say, all right, there's an issue, we're going to do a 60-day pause, and the market breathes again, then people get a little bit of a little bit more time. But there will be an issue where people are just going to have to pay up. It's going to hit that time threshold where the market is low enough for long enough that people are going to start to see real collateral calls, real margin calls, real inability to service whatever needs to be paid on a monthly basis. And so it'll be unprecedented when it happens from where we're at now.
Right. And if you think about it, I like the way you put it, and I also I feel like we all took the cue from Mike Green on this, and
Sure.
the algorithm is, receive $1 of capital, buy $1 of equity with no other inputs, and then you're talking about the reverse of that, right? Redeem $1
Right.
and sell $1 of equity. But when you're borrowing too on top of that, it really makes. And you're talking about 20 trillion in funds, like just everything that has the S&P 500, like the top, the three biggest funds, VOO, SPY, IVV, are like almost 2 trillion. Just those three funds are almost 2 trillion of nothing but S&P 500, right?
Yeah. Yeah.
So,
Which is to say
and
nothing of all the other.
close to 40% of that money is in 10 stocks.
Right.
you know,
Which means if something happened tomorrow, and I'm not saying this is going to happen, but let's say something happened tomorrow where one of these major Mag 7 companies was found to have committed accounting fraud. Not saying this is going to happen, but every once in a while, shit pops up, things happen, something unexpected happens, a key person at the top dies, or a company commits fraud, or there's some type of major like product liability or something. That
yeah,
something that innocuous could
yep,
be, or even more innocuous than that, could be the impetus for exactly what sets off a cascade lower, just by virtue of its weighting in funds like these. And so
sure,
we're really in a situation where we're putting so many of our eggs all in 7 baskets, and
right.
that's frightening.
Yeah, I mean, we've seen just in the past, I don't know, several years or something, uh, enormous one-day drawdowns. I know in Meta, you can look up on something like Investopedia, biggest one-day market cap losses. You know what I'm talking about, and
Yeah.
and and you'll see like minus 19, 20% in a day on a massive, massive market cap company. And how much of that would it take, right? I hear what you're saying. You don't know what it's going to be. You don't even know what the catalyst could be.
Specifically, if I had to pick, like, if I had to pick two names I was the most concerned about, and none of this is investment advice, and I'm just speculating and giving you a hypothetical, but
Sure.
you have a name like Tesla, where their legacy business essentially is in collapse,
Mm-hmm.
and the valuation is extraordinarily stretched based on the fundamentals, and so it's a call option on their future of robotics and AI and full self-driving. So, okay, like what happens if that doesn't come to fruition?
Mm-hmm.
Then also you have like a company like Nvidia, which has all these very interesting circuitous transactions and relationships with other names, specifically like CoreWeave and like Supermicro, that, and even Microsoft. I think they have a huge customer concentration issue with Microsoft, and so you do have a lot of eggs in one basket again, where it just, I don't know. Look, I was a professional short seller for like 10 years. I worked with some of the best short sellers in the world. When you do that, you start to just get a sense for when things might be askew. You see enough related party transactions and enough like, forensic accounting weirdness, and even just enough like sometimes behavior from a specific CEO, or, you just kind of have a finger on the pulse a little bit more than someone who has not been in that world for a while.
Right.
And again, I'm not saying that this is an issue with any of these companies. I'm just saying, like, for me, something like Nvidia coming in and backstopping CoreWeave's IPO when it couldn't catch a bid at $40 per share, and they have this, business relationship with them at the same time where they're reliant on one another. And then all of a sudden, CoreWeave goes to $150 a share when there was no bid for it during its IPO. Like,
Yeah.
I don't know, like that stuff doesn't make sense to me. And I understand option gamma, could be driving it higher, or speculation, but it's a convenient move for CoreWeave insiders, and it's a convenient move for Nvidia and anybody else that bought the IPO. But when
Right.
you look back at that day, there didn't seem to be an appetite for the AI story. There didn't seem to be an appetite for their stock at $40 per share. So I'm like watching carefully, even things like data centers too, and some of the valuations on some of these, legacy data centers.
I've
I'm just
noticed you
watching.
watching, Chris. I've noticed you watching. I've noticed you watching like Meta and Microsoft. You were writing about how, they're doing great, but the market kind of puked it back.
Yeah, well, on Friday, I just wrote a small note about that. The fact
Mhm.
that, that there will come, that's the action you would expect to see when valuations are peaking, right? What would
Right.
you expect to see? You'd expect to see a great fundamental quarter, because like Microsoft, for example, beat analyst estimates. Meta beat analyst estimates, raised guidance, right? So you got to beat from both of these huge names.
Right.
And the next day, the market just sold it right off. And so the market bounced yesterday, and now today it's selling off a little bit more. But those are the types of things that would suggest to me that the market says, look, despite this great quarter, how big can we make this delta between the fundamentals and the multiple that we're paying?
Yeah. I wanted to ask you about something else. You mentioned the options gamma just a couple minutes ago. And I've seen you write about, and we know about like the meme stock traders and the short squeeze and all of that. But you write about the weaponized options, when like this idea that if it goes the other way, if people start doing puts instead of calls, and it's this underlying feature of the market. I think it's like there, like people know it exists, or a bug, if you want to call it a feature or a bug. Like all of this exists, and it's something that's on my mind for a long time with all the 0-day trading, activity and everything. Can you just get into that a little bit and maybe enlighten
Well,
people on what you're concerned about there?
this and the passive bid, I've argued, are basically the two tails that are wagging the market dog. The market used to rise and fall because individual people would come in and buy Apple stock, and then that would drive the ETF a little bit higher, because it's highly weighted in there. And now the opposite is happening. People are buying the ETF, and that's driving Apple higher. And that's why you get these fucking insane out of whack valuations. Another, incredible feature of the market is when dealers sell options, when they sell calls or they sell puts, there's a certain percentage of the exposure that they get from that they have to hedge against. And so if I sell you a call option at a certain price, I essentially got to go out and buy that stock in a smaller amount to make sure that I'm reducing my, exposure, my counterparty exposure to that transaction. When that happens over and over and over again, and you get a million people piling into, the same stock at a strike price that's far outside of wherever the notional price, or far outside of whatever the spot price is at the moment, what you get is essentially forced buying from dealers that are trying to hedge against the sale of all of those call options. And when that happens en masse, then options become the flywheel that spins up the market's equities instead of, being a kind of side, derivative feature of the market that lets you speculate in addition to owning the equity. So between the passive bid and the options market, I'm not sure we've had a fair price on equities in forever. And, this is what happened with GameStop. People say, oh, was it just that people were, coming in and buying shares of GameStop all the way up to $350 a share? Probably not just that. It was probably had a lot to do with people buying the furthest dated strike. And anytime the options market makers would list new strikes, they go out and buy the furthest dated strike. And that would have, forced the dealers to buy the stock at whatever price. Plus you had some retail buying as well. When you think about the dollar amount that you would need to move the stock that high, that quickly, just buying the equity, the dollar amount to move it by buying options is significantly smaller. And nowadays, if you go on Wall Street bets, you just go look at it today and people are posting their wins and their losses. Everybody's trading options. Nobody even buys equity anymore. The entire market has become options. The entire market has become leveraged gambling. Top to bottom, there's no other way to put it. You have a cohort of less sophisticated investors who are making up a larger part of the market than they've ever made before. And their only means of investing is speculating on options, which become, again, a tail that wags the market dog. So when you look back to COVID, for example, and we had that huge dip, and then the NASDAQ basically fucking tripled off the bottom, despite the fact that the economic turnaround didn't appear to be substantial at all. And then you see an article like, I believe it was in FT, where, you're sitting around dumbfounded wondering like, okay, like, why is Tesla up 10x in 6 months, right? Like how could that possibly make sense? And you see these articles that say SoftBank and Goldman Sachs, I think, were the two names that were in there buying index calls off the bottom. So they were making these enormous leveraged bets that on an index ETF, which forces buying of the index ETF, which forces that cash to be distributed per its weighting to the individual equities. And so that works in two ways. So the same way that we blasted off the bottom, and you do see these insane moves like we saw in Tesla in December of 2019 to mid 2020, where it did, I think, 10x, which was bizarre. Those same moves can happen on the way down, which means like when market psychology breaks, whenever that happens, we get to a moment where the Fed and the president can't help, and people understand that, and there's no turning back, and there's no 6-month delay on tariffs at the last minute. When that happens again, you're going to see, options weaponized in the other direction, which I think could be extremely dangerous. So between that and the passive bid, we have these like two giant fucking trap doors underneath the market that, to me, perfectly explain why valuations are as batshit insane as they are now. You get all these great investors like Mark Spiegel, my friend's writing about the market cap to GDP and the historical PE averages, and it's just like how could we be here? Well, this market functions very differently than a market 20 years ago. We didn't have ETFs like we did 20 years ago. We didn't have options liquidity like we did 20 years ago.
Yeah.
Totally different market, totally unprecedented, situation that we've been in, is even going to monetary policy again. And so we're going to have totally unprecedented outcome. The worst part is, over the last 20 years, everyone has been conditioned to think that they should always buy the dip and there's always going to be a bailout or a solution from the Fed or from the government. And at some point, something is just going to break. And I'm not trying to be a fear monger, but it's just simple math. Like, we're just moving higher faster than we ever have. There's more speculation and more leverage. Margin debt's at an all-time high right now. Real rates are positive. The economy is starting to grind to a halt. So job losses will come next. Discretionary spending will start to, be reduced. That will hit earnings. And then all of a sudden, you're going to be starting a flywheel in the wrong direction. And then it's like, hold the fuck on.
Yeah. Unemployment could certainly hit passive flows too, right? The earnings
That would be what you'd want to watch, right? Like, that would be the number to watch for passive flows.
Right.
Hmm.
Well, gosh, let me just put a gun to my head real quick here.
Hey, listen,
No,
man,
I'm
I'm an optimistic dude. I'm not trying to be like Mr. Doom and Gloom. I think it's ridiculous how people that, just speak with any type of common sense and suggest anything other than like Tom Lee fucking like beating off to Ethereum on CNBC. Like, like people that suggest anything other than that, they're like, all of a sudden, like, oh, they're anti-American, they're against the market, they're this, they're
Right.
that. Look, man, numbers are finite. Math is math. Econ 101 is Econ 101. No matter how much modern monetary bullshit we want to fucking build on top of the basic rules of debits and credits and supply and demand, they're still there. And like Ron Paul says, like, eventually the free market and those natural laws of economics are going to have their way. It's just when and how, and who's going to be the scapegoat that takes the blame? Is it going to be Russia? Is it going to be short sellers? Who the fuck knows?
Yeah.
But really, it will be a mess of our own making when it happens.
Right. And you don't want to be the person caught up in that, I think, is the idea. Like that. That's
right.
why.
And Stansberry people know this too, because I remember in 2019, there's a really good cross section of like Stansberry's audience with kind of libertarian and Austrian school thinkers. At least that's what I can remember from drinking whiskey in a bar with some of them. But
Yep.
Could be a little hazy memory on that one.
No, you're right. You're right. And it's even, I would even say there's sort of a firm-wide bent in that direction. And certainly, look, I made a joke about putting a gun in my head, but I mean, I've been in this mode of questioning, speculative excess since May of 2017, off and on. I was hugely bullish, March, April of 2020 for several months, and then we just, it all just came right back to where we were. So yeah, I hear you. I've had to write. I write once a week, and I've had to write now and then. Look, I really am an optimist about humanity. I really am. I promise you, and I hear you sort of telling me the same thing.
When we crashed during COVID, for example, I was writing and talking on podcasts that I'm buying financials. I was buying JP Morgan. I was buying Goldman Sachs. I was buying, these companies that were trading at like 0.8 times book, 0.75 times book, like under 1 times book, because it wasn't a financial crisis. Like nominally, the financial system is always going to be there because the Fed is the lender of last resort always. And so I knew it was very different from 2008. So it's not that I don't think that there are things that aren't opportunistic, because I do. Like, I was saying that, and those names are all up like 3 or 4x since then in just a couple of years. And even, on my Substack at the beginning of every year, I put out a list of names that I'm watching for the year. And, only one of them was a short this year, and 24 other ones were longs. you just got to find where there is still some value. I'm not out there long the Mag 7. I'm long
Right.
things like gold miners, silver miners, things like psychedelic names, like all these little niche pockets of the market that, kind of under noticed. I was long nuclear coming into this year, which has been, has had a great tailwind. So I'm not a pessimist. I'm just trying to put together a clear picture of exactly where we stand based on common sense and not from this like echo chamber that you see. I don't really watch CNBC anymore, but I had it on yesterday and it was top to bottom, beginning to end to the day. Nobody was skeptical. Gundlach was on for a
Yeah.
little bit and he was like, okay, he was somewhat cautious, but every guest they brought on was just making excuses on why people should be buying now, which is a ridiculous thing to do because these people they're backfitting thesis as to why we should buy to the ridiculous price. Instead of looking at the price and making up their mind, which is like what I'm doing, they're making up their mind and then backfitting it to what the price is now, which is why you get all these asinine fucking price targets from people like ARK and like, all these sell side analysts that they don't have a sell feature. They don't put out sell reports. It just doesn't happen. So the question then becomes like, what bullshit do you have to make up? What do you have to factor into your fucking Tesla model to justify, $1,000 price target when the legacy business is in collapse? Like what? I don't know. I'm glad that's not my job. Like I would feel like an asshole trying to make something up to justify that.
Yep. I'm glad you mentioned ARK because recently they they send out these emails about their blog posts and things. And the one email that caught my eye was they were bragging about their year-to-date performance. And I thought, well, huge sentiment indicator when ARK is bragging about their year-to-date performance, in August or July or whatever it was.
Yeah, and
Something is up.
this
And
woman,
now they're saying they're
this
under.
woman,
Go ahead.
she promised 40% compounded returns some years back. You remember that?
Yeah.
Do you know how far off the mark she is from that? So like that's exactly what I'm talking about. Like I even wrote about that on my blog. I don't know if I can't pull it up real quick, I'm not going to. But here it is. Sure. Keeps moving the goalposts. This was back in 2022. And this was how she was listing things on her website. But she said, according to our current estimates, our more concentrated flagship strategy today could deliver a 40% compound annual rate of return during the next 5 years. Okay. So she said that in 2022. Okay. Mm-hmm. And has she compounded 40% since then? Actually, which would be I don't even know how ridiculous of a price that would be.
Yeah.
Let's just go back and check just for fucking shits and giggles here because we're having a nice time today. Yeah. She was at probably about $70 a share then, and she's at about $70 a share now. So she has an approximation over the course of 5 years produced 0% returns. So the difference between promising 40% compounded and 0 is a huge deal. 40% compounded from the original would have been, let's see, 70 plus 28. So that would have been 98 at the end of the first year, which would have been like 140 at the close of the second year. Right. It would have been 196 at the close of the third year. It would have been 270-ish at the end of the fourth year. And it would have been 3, 4, 32. It would have been somewhere between $350 and $400 a share now, and she's at 72.
Yep.
Just a little bit off.
A little bit off.
Just a touch off. Yeah. And if we
like,
have those returns,
3 months ago she was at like 40. Like she's just now up at 72.
Right, and the idea that you're going to have a compounding, some kind of predictable compounding effect on stocks that are, the fund still contained a lot of, and still does have a lot of kind of cash burning speculations in them.
Sure.
Is a little silly. There's no compounding with that. It's a pure speculation. And she keeps talking about investing in disruptive innovation. Well, you're speculating on kind of garbagey businesses. and
Right.
trying to replace them occasionally with, Google or whatever. But even that
And
is,
there is a whole tide of crap that needs to be taken out to pasture and shot. Like all this, speculation in crypto outside of, let's say, Bitcoin and Ethereum,
mhm,
there's hundreds of billions of dollars in speculation and leverage, and still have a ton of SPACs that trade, a ton of pre-revenue companies. I
yeah,
mean, all of that needs to get carried out,
yep,
all of it. And it will eventually. It's just a question of when.
right. Well, a lot of the SPACs are effectively destroyed. I mean, down 80, 90, plus percent. Cannabis has had its head handed to it. All the stuff that was a bubble in March or April of 2021, cannabis, SPACs, clean energy, bunch of stuff.
Yeah.
And there's still, I agree though, there's still a bid for it. I mean, that ARC fund, her main fund was up like 90% off of that April 8th bottom recently. So, you know,
Let me just tell you, if that miraculous move in Tesla doesn't happen
mhm.
in December of 2019 to, let's say June of 2020, where it was up 10x, that move doesn't happen. No one ever hears about Kathy Wood, and no one ever hears about Ross Gerber. And that's it. Those are the two
Yeah,
pieces of
Ross.
success that those two managers had that they clung to. Ross is now getting wise to Tesla. Wood, I think, even if she doesn't like it at some point, I don't think she can, I just can't quit you, like she's
Yeah,
got so many supporters that are like Tesla supporters and everything.
yeah,
And so they've clung to that. If that doesn't happen, that crazy December 2019 to June 2020 move in Tesla, which happened somehow right after Elon Musk got his pay package.
hmm,
But if that doesn't happen, no one ever hears of this woman ever, because she has one after the other invested in shit that's gone bankrupt, invested in stuff that's down 90% pre-revenue, this, that. I mean, there's just not I
yeah,
remember Ross Gerber buying Archimoto, which went bankrupt, I think. Like there hasn't been a piece of like pre-order, pre-revenue dog shit that these people haven't fallen in love with. And so I think at some point, that strategy is not going to work anymore. Who knows when that is?
yeah.
All right.
Well,
So clearly we're not buying the ARC funds.
yeah,
But
we're
I'm
not
not,
how do
buying
we?
those.
I'm not, look, I'm not giving financial advice. I'm just telling you how I feel about these things. You
Yeah.
guys can buy whatever you want.
No, I know. But what I wanted to say was how if somebody wants to hedge this, the passive bid, the speculative mania of the market, the fact that the Fed comes to the belief that the Fed and the government will come to the rescue at all times. What do you look at? Where do you go? And is it maybe it's something that's overlooked, that there's an area that you might be interested in that for people to consider?
Well, for me, it's like a combination, right? And so, like, I have some short exposure on the indices, which is like always like a place you can start if you want to hedge against the market going down. But then also, too, just like I try to stay diversified outside of the United States. Like, I have a lot of emerging markets. If you look at like even something simple like the EEM ETF, it's a good way to just get some emerging market. And then there's like the EEMD, I think, which is emerging market dividends. You can look them up.
Mm,
But for me personally, what I like is, I like owning gold. I like owning silver, gold miners, silver miners, even real estate, which I actually do think will also crash at some point. Um, but just trying to stay as diversified outside of what's driving the market now, to put it simply. Like
yeah.
right now, it's speculation. And so I would be more weighted towards value. I look at a name like, UPS right now, which trades at 12 times earnings, pays a dividend. It's a company that I am certain is going to be around in 20 years. His shipping is not going away. It's a business that's going to be here forever. UPS and FedEx basically have a duopoly right now.
Mhm.
So I would much prefer to look at a name like that than to speculate at 50 times sales on Nvidia or whatever. So you can obviously just get vanilla short the indices, But for me also too, it's having exposure to emerging markets. It's having exposure to gold, silver, miners. I even own some Bitcoin. I own a little bit of Ethereum. Anything I can do to kind of get out of the system as it exists today. But also like I own long dated puts on some of the indices. Just as a hedge, most of my portfolio is long, but it's just long in stuff that's not Mag 7 shit.
Gotcha. Yeah.
Right. Yeah. There's plenty to do. I would even say there's been plenty to do. Like we've made a long pick after long pick in our Extreme Value newsletter, and that's a weird thing to be calling a newsletter at all. And these days, people are like, "Value? Does that And I like how you unabashedly make constant reference to value and valuation. A lot of people now they're like, well, it doesn't matter anymore because market structures changed everything, and um, and you even refer to CAPE ratio was something I do. I didn't think anybody else on the face of the earth cared about that. Everybody thinks it's stupid, it doesn't work, doesn't tell you anything. I would say it's a great way to identify an extreme peak in the S&P 500. I mean, you can see
Yeah,
it. This chart screams at you. In other words, I mean, just
it does, yeah, and we're like near almost where we were all-time highs, which was leading into the tech bubble of 2000. But this started like
right.
10, 15 years ago, kind of with the death of active investing. You used to be able,
Mm-hmm.
great managers who are, were great long short managers like Einhorn, Chanos, these types of guys, like they understood to short bubbles and to buy value, and that's really what investing should be.
Mm-hmm.
But like active investing just started to crap out, 2 decades ago because of monetary policy and because of the fact that we've just decided to print at all costs and we can't take more than a 3% drawdown in the S&P. So the game has changed, but I still think it's temporary. I feel like these things always have a way of making their way back to historical norms, historical averages. And it's just a question of when that happens. And until then, you'll have to listen to everybody's bullshit stories as they try to tell you why this time it's different.
Yep.
Um, until then, you'll have to listen to people make the argument that 30 times earnings is the new 12 times earnings.
Right.
Um,
That's
and
right.
really, that's to me, it just comes off as arrogant. It comes off as hubris.
Yes.
And so I'm much more inclined to continue to focus on value because look, like if the market's trading at a 30 multiple and I can buy UPS for 13 times earnings and I feel like it's going to be a business there for a while,
Mm-hmm.
then what's the difference? Like, and how hard is that going to get sold off? Like, if the market collapses 50%, Microsoft's going to go down 50%, Nvidia is going to go down 60%, UPS will probably go down another 10 or 15%. And
Right.
so, you eventually find a bottom on names that are, value names that generate cash consistently, that, have these remarkable, like decades long cash generative businesses. But what people don't realize, and a lot of dip buyers don't realize, is that when you're buying something that is burning cash, or you're buying something pre revenue, or you're buying something that's unprofitable, or you're buying something that doesn't have any, that's insolvent on its balance sheet, essentially, like there is no bottom. When you talk about something like Fartcoin, like there is no bottom. It's not 1/1 millionth of a cent. It's not 1/1 trillionth of a cent. It's zero. And with insolvent companies and companies that don't generate cash, like they will die
Mm-hmm.
when the market pulls back, and that's just how it goes.
Yep.
It's like Silicon Valley Bank. Like sometimes you just can't meet your redemptions anymore, and there's just no more bid.
Right.
And psychologically, when we start to make that change, and people start to realize that effect will cascade further and further. And then our discussion today about buying UPS at 13 times earnings versus buying Nvidia at whatever 100 times sales isn't going to look as fucking stupid as people think that it's going to look now when they see it, because this time it's different, Dan, and me and you are the only people that don't get it.
Right. And I recently noticed that. Well, actually, let me just say first, I'm glad you mentioned David Einhorn because he was very smart. he was not getting great results. And then he said, well, it was almost like he thought about where do investment returns really come from, is what I took from his comments at the time some years ago. And they don't come from the market constantly pushing the valuation high forever, because that doesn't
Right.
happen. They come from cash.
Right.
And how that cash is deployed. And if the cash is deployed in a manner that basically sends the return straight to the shareholder, whether it's dividends or share repurchases or something else, then you found something, in my opinion. You found something if you've got a business or a company. I even actually recommended a publicly traded master limited partnership, which I don't do a lot of, but I thought the more I looked at it, the more I thought, well, this thing's gushing cash. It's going to keep gushing cash. The balance sheet is a fortress, and the cash is going to make its way into the shareholder's pocket, right?
Right.
So it's going to be a big return, even if the market hates it. In fact, if the market keeps hating it, the cash will keep flowing, and you won't be
Right.
able to avoid the return, right? That's what I want now. That's how I'm trying to get around this, because buying, as you say, the top 10 of the S&P 500 at 50, 100 times earnings is just crazy. It's not a way to get returns. Historically, it's just never worked out well. The guys at Research Associates, Rob Arnott, they do their what's it called, big dogs or top dogs research, where they show like the biggest companies in the S&P 500 kind of change every so often, every decade or so. They're different because when they get up there, they perform like crap for a decade.
Right.
So yeah, same page. Look for
Yeah.
cash gushers. I've been looking for cash gushers for years, and I think now it's like more important than ever. So cheers to you. Cheers to you,
All right.
UPS. Not investment advice, but cheers to the UPS argument, if not the investment. All right. Well, a guy like you, I could just like throw you softballs all day because we see the world similarly. But we've gotten to the point where we can ask our final question. Take as much time as you want with this. If you've already said your answer to the final question, by all means, feel free to repeat it at length, whatever you want to do. But it's a simple question. It's the identical question for every guest, no matter what the topic. And it's, if I could just get you to leave our listeners with one idea, one takeaway today, what would that be?
Shit. You mean like an investment idea or just anything?
Anything. I've had people say,
anything.
go outside and spend more time in nature, and spend time with
That's
your
a great
family.
idea.
Yeah, or go, go to my website. Some of them say, it runs the gamut, right?
No, I would just say like the two things I would remember are that the MMT cycle that we're in, it's accelerating, and as it accelerates, it widens the inequality gap, and at some point something is going to break from that. It's the problem that everybody is complaining about, which is the haves have more than the have-nots, but both parties advocate for monetary policy as it exists today, and all that does is it pries open the wealth gap faster. It makes the rich richer. So if you look at a chart of the bottom 50% and the top 10% of net wealth in the US, the top 10% is quickly moving further away from the bottom 50%. And the same parties that say that they're trying to, take care of this one way or the other, it's a little bit more of a talking point on the left, I would say. Those same people advocate for MMT and the monetary policy as it exists today. I really do believe that we're at a insane inflection point right here where the Fed is absolutely cornered. Inflation is at 2.8%. They're going to have something is going to have to give, because they're not going to be able to raise rates without, or I'm sorry, they're not going to be able to lower rates without inflation starting to tick higher. And they're really at a spot where eventually they're going to have to choose between basically a quick like deflationary depression or like inflation. And it feels like with like introducing stable coins into the system to buy treasuries and this entire crypto ecosystem that we are like quickly embracing and threading kind of into the like material of our financial system, specific even to the Treasury. It just feels like we're at this strange point where, like, okay, we came off the gold standard, and now we're at the we've gone from the gold standard to fiat transition, and now we're kind of at this fiat to digital transition, where even more rules just kind of fly out the window because we have even more like ways to micromanage the money supply. With the market where it is, so extremely overvalued in my opinion, and the Fed basically out of options, from at least from the way that I see it. I mean, Jim Chanos said to me once, I'll never forget, like, this is years ago, but he said, this is an unprecedented experiment in monetary policy, and it's just going to have unprecedented results. And so, the more complacent everybody gets, the more non-complacent you should become. The higher valuations get, and the more you see other people making money, the more cautious you should become instead of, giving into the FOMO. The point is, all these great investors, Einhorn, Ackman, et cetera, we're all great contrarians, and you have to be a contrarian if you want to make money, because you have to identify massive trends and massive breaks in trends before they happen. And so all I'm trying to do is bide my time until the inevitable happens and just make sure that I'm not caught up in that hurricane when it does happen. And that doesn't mean surrendering gains. I'm beating the S&P this year on my 25 stocks for 2025. I'm beating the S&P by like 30% on those names, right? Why? Because I have nuclear, I have gold miners, I have psychedelics, I have, all these other areas that have done extremely well despite the fact. So you don't need to be in the same like dog shit that they're pumping on CNBC every day. But just be wary of the fact that like things are not as they seem. And it's like COVID, like, one day it's not a big issue, and then you wake up the next day and people are fist fighting over toilet paper. And that's how quickly things can change. So it's times like now when people need that reminder that like, hey, this animal spirits or whatever bullshit you want to label it, when somebody buys a stock at 59 times earnings, whatever you want to call it, animal spirits, market's appetite, those things only last for so long. And then when they're done, they're done. So this is like the stairs up, elevator down analogy, whatever you want to call it. But and do your own research. That's it. I said that in 2019 at the Stansberry Conference. The lessons I learned from being being in the short selling world for 10 years is that everybody's a liar. Everybody's a fraud. Nothing is as it seems. There's a whole underbelly to this world that makes things run in the way that they do, that the average person would shit themselves if they saw even 10% of. And so just be like vigilant about protecting yourself and protecting your family and your community, and just keep your head on a swivel, investing and otherwise.
All right. Well, thank you for that, and thanks for being here, Chris. It's been a pleasure to talk with you.
Yeah, my pleasure. Thanks so much, Dan.
That was great.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.